Are you with JP Morgan and Morgan Stanley or Yardeni and Evercore?
I'm with Dr. Ed. As you know, John, we've been constructive on risk assets going back almost a year now. We talked about Europe back in 2022. It's up about 35% over the last 12 months. We talked about Japan at the beginning of the year with you on this show. It's up about 15% year to date. We believe, we wrote in our 2023 outlook, which we published back in November of last year, stability ahead. And I will just note that currently, virtually every volatility index across all assets are at a one-year low. So we believe we're through COVID. We're through the inflation spike that came about from COVID. We're through, as of next week, the rate tightening cycle led by the Fed. And we're approaching what we called in our monthly published last week, the birth of the new. And the new is consisting of the Biden de-risking of China. It consists of a new inflation target regime, a high nominal growth world of 3% type inflation, the end of yield curve control in Japan, which is super bullish, and the shift to domestic demand-driven growth in China from export and fixed asset-led growth. There's a lot going on, John. And much of it is quite positive.
Jay, you're still looking for leadership from elsewhere?
Well, no, John, we found the leadership from elsewhere. Look, where there's smoke, there's fire, right? And so the cyclical sectors are already starting to move in the U.S. They're sniffing out the fact that next week, not only will the Fed go on hold or pause, we believe that's the end of the rate tightening cycle, given where we expect inflation to be sub 4% with the June report on a year-over-year basis. So mid-July, inflation in the U.S. is going to be under 4%. The Fed is finished tightening. But more importantly, John, next week the Fed is going to update their economic forecast. And what that's going to do is they're going to increase their GDP estimates for this year and next year. And that is going to signal the end of recession risk. That's going to force the bears into the market, take us over 4,300, new bull market. We have $6 trillion in money market funds, so much cash on the sidelines. The rotation is already underway. If you look, the transports just broke above their 200-day moving average. The industrials are breaking out. Home builders are up 20% year over year. The cyclical sectors are starting to work, and so that's the rotation, which we wrote about 3 to 4 weeks ago. We titled our musings rotation to make it very clear to people, and it's happening. And markets are forward-looking discounting mechanisms, John. So it's already underway, and so we have a barbell. We have tech on one hand. That's done phenomenally well. Semiconductors, the pick and shovel of the AI age, but that's overbought. And now we have the cyclicals on the other side, industrials, transports, home builders, financials, and energy, and that stuff is starting to work, and that's the opportunity as we see it within U.S. equities.